financial house in order. The recently announced interest rate hikes may have some far-reaching consequences.
And last week's 0.25% increase was the second this year, and it likely won't be the last, the Fed says, thanks to a booming economy. 2 more increases are expected before the end of the year. Let's bring in personal finance expert Shani Curry St. Welcome.
Hi. Nice to see you.
Thank you. Thank you.
So explain the different ways consumers expect to be impacted.
Okay, so first of all, retirees will be happy about this because what they're going to see is that the rates on their CDs, on their money markets, and in their regular savings accounts, they're expected and predicted to be able to benefit from that, because what happens when you're charging more for interest rates, for mortgages, for credit cards, you have a little bit more that you can share with the consumer that's making deposits at the bank.
So this is going to be, it's going to be costing people more money to borrow money. So let's go through some of the different areas. Credit cards, for example. What are people going to see if they're carrying a balance on their credit card
so
statements?
While the retirees will be happy, those that are borrowing for car loans, they're not going to be as happy because they're going to see that their interest rates are going to go up. Predicting that they'll see those changes maybe about $30 more on a monthly basis. And if you do $30 more on a monthly basis, that's about $9,000 for the year.
That adds up.
And yeah, that tends to add up. Those that's looking to purchase homes, if you're thinking about a house maybe in the standard rate of about $200,000, you're going to experience additionally that $40 a month, which also equates to that additional $9,000 within the year. So maybe it won't feel so tight on a monthly basis, but if you look at the more you're paying for the loan over the time of the loan, you'll feel definitely the impact of the increase for sure.
Kind of the same way people advise you to save a little bit every month and it adds up in the long run.
That's exactly how,
this
is exactly how that rate change is going to feel. So for those that are kind of on the fence, thinking about if they want to go ahead and purchase a home, then they need to kind of hop to it because those rates are going to continue to go up. You want to try to lock in your rate if you are in the negotiation process, because they do have the tendency to go up under this market for sure.
I mean, interest rates were kept artificially low for so long.
Yes.
Because the economy wasn't doing well.
Exactly.
So
exactly.
If we were to look sort of at a positive here, the fact that the Fed is raising interest rates is a sign that things are going pretty well with the economy.
Well, it's a sign that it's going well for the economy, but when you're purchasing a house or you're having to buy a car or you're looking at your credit card statement on a monthly basis, you're really feeling that pinch. And if you're kind of already up and, if you check Experian, it'll tell you that Americans are at the all-time high when it comes to credit card debt. So when you're talking about just pushing just a little bit more, those that are paying it out are really feeling that pinch.
Yeah, individuals will feel that for sure. So what do you advise clients to do right now in order to take advantage of the good aspects of this change while minimizing the negative aspects?
Okay, so the biggest thing is if you're purchasing an auto loan, this for those that are, because they're predicting there's going to be 3 more rate increases. So if you're thinking about making a major purchase, then you don't want to keep sitting on the fence, because sitting on the fence is meaning that your rate is going to escalate, and when your interest rate goes up, it's going to impact your principal. So that's the first thing. If you're in the housing market, you want to jump to it. You don't want to be going back and forth and some trivial negotiation, because it will cost you on a monthly basis. On your credit cards and things like fixed rates, this is probably not the best time to be borrowing on something adjustable. It's just not, simply because those rates can definitely fluctuate. So if you feel that you're already tight in your budget, the sooner the better, and try to minimize what you get on rates that are moving. You want to lock it in as soon as you can.
And real quickly, if you are looking to sell your home, what is the adjustment? Do you have to maybe bring your asking price down a little bit?
There's a huge possibility. There's some predictions that's saying that, simply because when interest rates go up, then there's less people wanting to purchase a house. So if you're getting ready to sell, then you probably want to control your price, simply because there's not a whole lot of people on the market that wants to buy at that price point.
On the other hand, maybe a whole bunch of people will jump in right away, hoping to get a cheaper rate than.
Well, those that have cash, that's what Warren Buffett says. When there's blood in the street, there's money to be made. But it really depends on which pocketbook that you're holding. So that's really the big thing. So if you are like the average consumer and you want to make a purchase, you want to do that sooner than later. If you are a retiree, then you're going to kind of be a little excited, because you're going to be seeing a little bit more going to your CD, going to your savings account, going to your money market. So those kind of things are going to excite you. When you're looking at your credit card bill, you may be a little agitated, because those rates are flexible. They're not locked in. Those APRs are moving. The average is 16.85%. They're predicting that those will climb. So you're going to feel the pinch for sure.
Okay.
Shani Curry St. Always good to see you, Shani. Thanks so much for coming in.
Thank you.
Thank you.